All right. Good morning, everybody. So we got CPI today, which gives us an opportunity to perhaps see a liquidity close gap play. I generally take the opportunity to show what we're looking for, and I will, of course, show you examples of what we don't want to see. This pattern happens all over. You can find it on multiple time frames, and even on the intraday, it can happen outside of the economic events, right? It can be just in the middle of the day on news, it could just be some European close around lunch. Anything can generate one of these candles. So it's a lot like drop based rally or rally based drop if you've seen any of that work. Only we're looking for a single leg of price. It can be up or down. I'm a little picky on what I want to see if I'm focused on it as a gap. And no matter what happens with this candle after it's closed, you can use your quadrant lines to measure out that one particular candle and then extrapolate from that target levels above and below and catch the midpoint of it. So one of the things that I want to see is that there's no wick going in the other direction. So we can see on this one, which happened to be a CPI example, we got the 830 print. It didn't even try to go to the downside at all. If we break that candle into 4 quarters, then what we'd notice is there's the midpoint and then the upper 25% and the lower 25%. So just think of the mid 75, 25. That's not accurate, but you get the idea. With no wick on the bottom, we want price to close above the 50% and preferably above the last 75%. So we want it to close up here somewhere. Build a base and then work its way down and get the gap closed. Even if we get the setup, it doesn't mean that price is actually going to work its way down there. As in this example, we never got there, right? It gave us the setup and it did not come back and get the gap closed. But if you had measured this candle when price did break out, one, we got a Busby there. Two, it went 50% of the entire candle's measurement. So if we had put quadrant lines on this and measured it, when it broke out and went higher, we got a 50%. From there, we had a really nice reversal that was tradable. And if we had marked the mid, price got back to that. So nice setup. Here's another example. No real wick going in the other direction. It closed in the upper 25% of the candle. It didn't really put in much of a base, and it got back to the gap before 11 o'clock. It's around 10:30 when we got there. If you put your quadrant lines on here and measure to the downside, I don't think that hit 50%. It might have, but this did, right? On that pullback, the first pause was 50% of the event candle. Here's another example. Big bar going in one direction, no real wick going the opposite direction. Put in a base, retraced to 50%, finally got back and got the gap closed around 11. And I'm pointing this out. Look, if you don't want to trade it, I don't care, right? I like it. I use it for analysis. I use it for trading. I use it for all sorts of stuff. But at the bare minimum, if I can save you from going the wrong way, then I can help you out, right? As I see people who see this and they think, oh, we're crazy bearish, I'm going to short the hell out of it. Yeah, how'd that work out, right? That didn't work. So, not to say that the short wouldn't have been good. Sometimes it can end up being a great short, but by default, just don't get one of these candles and assume that that's going to be the direction of the day, right? That we're just going to keep mowing on in that way without getting that gap closed. And I know I hear from new traders who say, what gap? I don't see a gap. There's candles all over the place. This isn't a gap in price. It's a liquidity gap. And this isn't really the forum to explain what that means, but the idea would be that we moved really fast. We didn't get a lot of structure behind us, and we left liquidity behind. So there's nothing really holding us up. And when we go and test what is below us, there's nothing there, and we fall back down through it. So here's another one. No real wick on the bottom. It's another CPI day. We closed in the upper 25%, but the run wasn't done. Continued moving, put in a base, got into the open, worked our way back down. We got there between 10:30 and 11, really closer to 11 than 10:30. One of the things you'll notice is when we get these gaps and we get them closed, the 8:30 gap, a lot of times, most of the time, the gap is going to be closed by 11. If we get one of these and the gap is closed in 10 minutes, it's not what we were looking for. At least it wasn't what I was looking for. But as I said before, I'm a little picky, right? I'm only going to trade it if it's exactly what I'm looking for. If it's not, then all right, I'll mark it out and use it for analysis, and I won't trade it. But I can still use it for analysis, so it's still worth something. This is what we don't want to see. This was also a CPI event. Big wicks in either direction. Price comes back to close pretty much where we opened. There is no gap here because we closed almost where we opened, right? There's nowhere to go. We've already went. So if we get a really big bar like this, we can use the quadrant lines, measure 50%. That's where we topped out that day. We wicked above it. We tried to get through it. We couldn't. We put in a flat top rising wedge, which breaks to the downside, and we did that. So there was still tradable opportunities. Even on this pullback here, it didn't quite get back to 50%, but it was really close. So there's still a lot to be taken from one of these really big bars, even if it doesn't give us a gap close play. Here's another example of what we don't want: big wicks on each side. If we had measured the midpoint, it's where price came back and responded to. If we had measured the whole thing and plotted it to the upside, you can see that we would have hit those levels. So these big event bars have a lot to offer, more than just a liquidity gap setup. It's another example of what we don't want to see. So when we get the print at 8:30, I'm using a 5-minute chart here because it's what I usually use on an intraday to do analysis. I'm looking for a 5-minute candle of this style. You can use whatever candles you want, right? But you'll have to go in and reevaluate what one of these big bars look like on the time frame that you use, and then do all of this work on your own to figure out how you're going to use it. The best way that I can recommend that you do that is first go back to all the CPI, PPI, non-farm payroll days in 2025 as a good starting point. Look at the 8:30 print when we got them on whatever time frame you like to use. Take pictures of it and start measuring it, marking it out, plotting it out, and seeing what happened that day, right? By doing that work, you'll get to the point where you recognize what you're looking for and know how to trade it. So the markets are sitting around waiting for this. We're getting a little bit of a bump in the NASDAQ, which is kind of funny because banks are kicking things off today. And NVIDIA got really good news. And so it's a competition between good news at the banks and good news in chips. We can see the Dow basically flat, sort of fading into the red a little bit. Hong Kong down 0.25%. Japan just above zero, hanging out with small caps. And the S&P near 0.5%. The good news on NVIDIA seems to be bleeding over into the other chips as well. We'll see how much we get out of that. But this is really good news, especially with earnings, not necessarily for earnings for NVIDIA right now, right? That doesn't fit into what we've got. But the other companies that are going to be reporting that connect with NVIDIA. We have a lot of Fed speakers today. Not expecting much out of this other than, if they continue to support the idea of tossing Powell out, the markets may react a bit to that. If they're all getting on board for getting rid of him, if they're not defending him, if we start to see a change in tune, then yeah, the markets might read something into it a little bit, but otherwise they're not expected to provide any new insight, perspective, nothing, right? We shouldn't get anything out of them, but we still need to be aware of when they're going to be talking, simply because the markets can take them out of context. Reporters can misrepresent what they said. They can just flat out say something that they didn't mean to say. So there's a lot of ways that when they speak, things can go wrong. So even though we're not expecting anything out of them, be aware of when they're talking. We had Secretary of Treasury Scott Bessent on this morning at Bloomberg. He didn't really say anything. He likes to play the fool when he doesn't want to answer questions, and he didn't want to answer any questions, so he's just up there acting a fool. Gonna get some stuff out of the Bank of England kind of early or late. It depends on how you want to look at it. But it's at 4, so that shouldn't really bother us. Really, once we're done and the market opens, we're pretty much done with any of the economic calendar at that point. And the rest of it's just going to be Fed speakers chipping teeth. The thing about these resuming sales of these chips, they had already priced those sales in, and then the new administration came in and said, yeah, no, you can't do those sales. So they had to pull the sales out of their forecast, their earnings forecast. And now they get an opportunity to put them back in again. But this is sales that had already been established and planned, right? This isn't something above that. So, just keep an even keel with the whole NVIDIA news. And so far, the banks have come out strong. If you didn't get a chance to listen to Jamie Dimon, he's one of those influencers that really matter. What he says has a lot of weight. And he wasn't giddy. I don't know if that word fits, but he wasn't dour on the market either, or on the economy. So as we started this week, GTFO, right? We got to get out of the box. We're trying that this morning. Dollar just in this really beautiful move to the upside, consistent and persistent. That is the very definition of trend here, right? Really clean, higher highs and higher lows. But you can see where we stalled out a bit, and now we're resuming that move. We do want to see that continue, just not really big, fast, sweeping moves like we saw back here, right? This is what we want to avoid, those big drama events, up or down. This was in the down move, but it can go either way. We don't want those big sweeping moves. And so far, that's not what we're getting. How it's moving is oftentimes more important than where it is at the moment or what direction it's moving in on a day-to-day basis. For the 10-year, topped back out at 4.44. we'll see. Right? It's a nice little collection distribution here. We'll see. The main thing at this point for the 10-year is that just like the dollar, it's not making these big exaggerated swinging moves. $73,000 in the overnight. So volume's good. Friday was 79, so we're not out of line. It's a little higher than the 50s that we had been seeing, but it's fine. The put wall was rolled up, which is a little bit of a surprise on CPI week, or not CPI week, the OPEX. Like where are they going? And I don't know, we're running out of time on that thing. It very likely doesn't have any weight. It's possibly just the algos recognizing a new position ahead of OPEX that wasn't as large yesterday as it is today, right? That we had options that expired yesterday that once they were taken off the board, highlighted this next level as a high level, and that's where we happen to be at now. So we'll see if it's still there tomorrow to see if it has any weight behind it. Otherwise, having the put wall roll up is considered a bullish posture. The call wall didn't roll with it, so that kind of caps out the enthusiasm. And it's what we hit this morning, right? When ES ran up into the call wall. Right there. So hitting the call wall in the pre-market, yeah, I wouldn't be surprised if we end up going back up there again, but we might not get the chance, right? We're already trying to normalize in front of the CPI data. And of course, when we get CPI, goodness knows where we're going to go from there. At the very least, we'll be looking for reciprocation, but it's likely we're going to get that even before we get the CPI data. It is worth noting that we are a long ways above the zero gamma line. That has nothing to do with any sort of mean reversion, least squared methods, dot plot statistics, or anything else that would highlight or indicate that we're going to mean revert and go back the other direction. It's more of a concept of what are the dealer dynamics and their behavior going to be like, if we try to, say, break out above the call wall and still go higher, which we can do, right? It would just be difficult to break out and go higher above the call wall, but it's doable. And the analogy that I've used with that runner running up a hill and adding more weight to them as they run really fits. Price could break out and continue to go higher, but the amount of effort and work required to get us to go higher from here would be much more significant. Right? It's harder to run up that hill than it is to fall down the hill. We reached the ADR early in the day, which implies we can go to the other side by the end of the day. This has nothing to do with any sort of bullish or bearish bias. It's just a market reaction, right? It's just price doing what price does. We did get a trend line breakover. So we did it. We got it. We already made it back to the top. So it doesn't owe us anything at this point. And we've reached the ADR half early enough in the day, which says that we can now go to the other side by the end of the day. And make no mistake, we can do like a dribbling basketball, right? We can get this side, and then we can get this side, and we can come back up and get this side, and even get that by the end of the day. Just that's what price has done before. It can certainly do it again. especially on a CPI day, which could, for an example, give us a really big liquidity gap to the downside, and then we tag that level, and then we run back up and get the gap closed, and then we overshoot it, and we go up and get the full ADR on the day. We've seen it happen before, so it can certainly happen again. The thing about this reversal from Monday into Tuesday is it already gave us the TRB target. We're already back up to that 63.32 cog line. So it doesn't owe us anything more in this run. And it's been a nice run, right? If we kind of expand out our view here a little bit, it's been really nice, clean, consistent run. But now what, right? This is the range that we've been working on since not last Friday, but the Friday before that, and into the Thursday that went with it, right? So it's a long time we've been in this range, putting in a lot of work, and there's a lot of liquidity above that box and below that box. It's going to be hard to get through there, and we're going to need some sort of event to catalyst something to get us through there. We also have a market maker move, and it's really small at this point. There's a couple of things to note when it comes to a market maker move. One is that oftentimes we will see them on OPEX week. So for the most part, you want to discount them in general just because, well, it's OPEX week. You can go in and evaluate what strikes were traded to see if you can spot, for an example, the trades that were put on to see if it was a part of a hedge dynamic or a part of a roll. Sometimes you can figure it out, sometimes not, right? Options can't always tell. But here we can see it wasn't because they're rolling. Open interest was less than 1,000, and the trades that came in are greater than 1,000. So if they were rolls, they would have been rolling something that was already open. These are new positions. These are hedges that are coming in. Additional protection or additional insurance against possible moves that could happen today. That is what they're doing. Oh, I have the vertical on. Hold on. Yeah, still bigger than, so it still sticks. You see thousands in volume on strikes that don't have open interest greater than that. So these are new positions. They are insurance or protection, or use any word you want there. That is causing the market maker move because these out of the money options that are traded, the pace and the frequency of the trades increase the implied volatility of the out of the money options, which increases the implied volatility average. And when the average in the front expiration gets higher than the next average out, you've got a market maker move. We've got 1283 in the front and 1275 in the back, and that's causing this market maker move to happen. So they're worried. They're worried enough to buy additional hedges to protect in front of CPI. I mean, we don't have some outlier forecasts. This has an outlier, but it's more of a survey than anything else. Don't really expect much out of those manufacturing surveys. But if it misses the forecast by a high enough number, we could see something. The main thing is going to be keep your eye on the market maker move and see if it continues to grow or if it's going to start to shrink, especially after 8:30. It is time sensitive, so by the end of the day, it's going to be gone one way or the other. So it will start to decay once we get on the other side of noon or the other side of lunch. But we would want to see it disappear before then. And the assumption is that it's CPI that's causing the angst or the doubt and confusion, and it's why they're hedging. In fact, it just moved, right? It was 0.08. Now it's 0.07. So they're reducing the size of the hedge already, and we're not even at CPI yet. So whatever spooked them or sparked this fear, it's already starting to unwind. Perhaps they were more worried about the banks reporting than they were the CPI report. Not necessarily an unfounded fear. Since we've already reached the ADR half and started to drive away from it, we should continue to stay away from it and move in the other direction. If we re-challenge it and get above it, we open the other table. 63.72 is the target above that. Right? We just go on up there and get it. And this, if this happens to be one of those rally days where we just keep going and going and going, remember that the SPY and the SPX does not have the ADR lines until 9:30's open. So say we break out and run to the upside and the ES gets to the yellow line and it gets above that and it continues to run. We're then left asking, well, where the heck are we going now? We got blue skies, nothing above us, no ADRs. What's up there? Go to the SPY and the SPX and monitor their ADR lines, because they'll hit those even as the ES is driving a, completely beyond these ADR lines. And then watch the percent gains, because the futures are a lot easier to read on how far we've gone by using the percent. We start to get into really odd options dynamics when the market has moved more than 1.5%, and then when it's moved 2%, and then 2.25% and 2.5%. So keep your eye on how far we've gone on the percent basis. Today's floor pivot is lower than yesterday's. That's bearish. Price opened above it. That's bullish. Those two sort of cancel each other out. It's a wider channel today, which implies if we break out, that the breakout won't stick. Well, surprise, we did break out, and so far it has stuck. We have an MDP at this point. That's a missed daily pivot. Markets generally hit that pivot. The number is like 80% of the time, but I think each market has its own number. The idea, though, is we tend to hit the pivot more often than not. So the fact that the pivot is below us and we generally hit it and we haven't implies that if we start the breakdown, right, we're setting up a TRB here, that 62.92 cog line or today's floor pivot wouldn't be a bad target. The channel offered a little bit of support when we opened in the Globex, but I wouldn't expect that to work later in the day. And if we measured this run that we got from the Asian Open, we got the 111 or the 1236 on the breakout. We've already rejected that. 786 held when we pulled back to test, and that's going to be the line in the sand that we want to see hold. Otherwise, we open up going back to this channel down here. We're done with that. The gap is done. So we are back above the weekly floor pivot, which is good to see. We're bullish above, bearish below. Now that we're above the weekly pivot, we don't want to go back below it. If we were looking for an R1 S2, we didn't get it. Now that we're at the R1 and we're holding out around that level, which happens to also line up with this liquidity gap target, the gap is closed, right? So we don't have to worry about that. that needs to hold. That whole 63.32 cog line area, we need to keep it. 63.50 for the R2. And then if we get really wild, 64.05 is the R3. And we can see that while the floor pivots aren't far off, on the red side, the R levels, they're really close together. But on the green side, they're much farther apart. That's because these lines are all math, and math is projecting more to the downside than to the upside. It's just the way it is, right? So another indication or another reason to believe that, sure, we can go up from here, but it'll take more effort and more work, and that statistically speaking, we're more likely to go down from here than up from here. Person's pivots, by the way, have that built in as a function of the way that it runs every day. So it would show you the direction. I can see it anyways because I use these every day. But if you don't, it would already give you the implied direction in person's pivots. Person has a lot of indicators on here. So just type his name in, person, and you'll see that he's got like 6 or 7 indicators. They all kind of tie together, called person's pivots. There's a lot of pivots on this platform. We don't really have a classic shape this week. Since we've put in a lot of work up here, we're starting to develop a second distribution zone. So like a double distribution, but it's not big enough yet to be a double. So it's just this weird, odd shape. Eventually it's likely to fill out a lot like this did, but it's still kind of early in the week. And this distribution was along the lows and sets up more like a lowercase b classic profile. And then, of course, we had the classic D shape, and we're in the week we are now. So it's still early, and this is a really ugly performance, and there's nothing much to it at this point except 63.05 and a lot of footprints that we put in there, a lot of work that we've done this week at that spot, which was interesting, right? Because they didn't front run it at like 62.90 area, and they didn't hit it right on 6,300 options zone. They was above that at 63.05, and man, you could really see them yesterday. Very likely some traders' remorse, right? If we get back to that level. $10-day, 30-minute volume profile with TPO. We have a discrepancy between the TPO's point of control and the volume profile's point of control. And this is just a big sloppy mess. There's no classic pattern or classic shape, no clean distribution. Even the value area is covering the entire zone. So nothing out of any of this other than where the point of control is, which is isolated and all by itself and doesn't match the TPO. So this is just a sloppy mess, trash at this point. Even when we start to tighten up, say we lose the next couple of days worth of volume, the width of the range isn't even going to adjust that much, because we're going to go from like 62.30 to 62.50, right? We're going to shave off 20 points off the bottom. That's not going to clean anything up. So what a mess, right? Do want to see what we do with this current level that we're working on. And if we're able to put in a lot of work here to see this point of control roll up. Otherwise, it's at a really good spot, that 63.05 that we were just talking about. And as long as it remains underneath this, we're good. The thing about having that point of control there is we can sit in this zone and we can go above and below that level all we want. But if we leave the zone and then we come back into it, it will act as support or resistance. When we try to work out where the zone is, this is a really wide range from that 35 down to 60. We can do that, and it's not going to act as a support or resistance. We'll have to get farther away than that and then run back into it to see it act as any sort of support or resistance at this point. But we'll take it as gravity, right? Or the center point of this trading zone that we're in. And eventually, right, it's going to end. We can't stay in this zone forever. So yesterday we got our first touch play off of that 6,300 VPOC level. So we're done with that. And last night when we got into the open, we hit yesterday's VPOC. So it's not we hit yesterday's point of control. So it's not a VPOC. There's nothing for me to carry forward here today. We ran right through it like it wasn't even there. But on the drop back, it's where we tried to catch some structure. I don't think that it had anything to do with this little bump here, but either way, the textbooks will tell you to carry that line forward. If you don't have enough pivots and you want more, that's a good one to carry. Or the value area high and the value area low. I've got enough pivots. I don't need any more, but whatever, you do you. The TPO and the volume profile this morning, they match up really nice. There's no discrepancies. Really not getting much hints either way of what's coming. We just need to see it play out. So no real insight from the 5-minute profile. We're back above Friday's close and working towards the upper edge of the week's range. 63.86 is how far we were projected to travel for the week. We can wick out of the box, but we would want to be back inside the box by the end of the week. The box being this range here. Last week, we pretty much stayed in the lower part of the weekly expected move for the whole week. Right, that's the upper edge of last week. We just stayed in that lower range. It really highlights how tight this zone is that we've been working on. And we're getting that breakout this morning. Even before CPI, we started the breakout. The concern is that we get a fake breakout, fast failure, and we just dump right back in again, like a rug pull, right? So price, when it does this off the highs, we have different terms for it. So this would be like a blow off top sort of play or a rug pull. So we're looking for a gap up, maybe even a bit higher on the run. This is a Globex open, but at 9:30 we could see an open, like up here somewhere. So then it'd be close here, open here, then we get the run and the drop, and it just leaves this long wick behind. That's if it all starts to unravel from here, right? And go back in the past, you've seen those sort of plays before. Of course, I'm looking for it. I won't find it. It'd be a bit like this one here, except we would have expected a higher gap first, right? So gap up, a little bit of a run, then a dump. Otherwise, we get a nice breakout from here, we continue this drive to the upside, and the target is the range of the week, 63.86. Pass that into 6,400. And we got OPEX at the end of the week. So, it's more likely that even if we get above that call wall at some point this week, we come back down below that call wall, or we see it rolled by the end of the week. And it'd be odd to see it rolled later in the week, right? That would be odd. We're still above the 10-week, and we're holding fine. We're not seeing any extremes here. This is just a good place to be. I'd like to see it get a little closer to 3%, but really nothing wrong with our distance from the 10-week. And we're still holding in this zone on our distance from the 10-day. Staying above the 10 by 1% or below the 10 by 1%, it's just a good place to be. We got a little extended for a while, but we're back inside the box and it's fine. We're just stepping down, nice and easy, calm moves, nothing extreme. And that's what we would expect in a positive gamma environment, right? If we were in a negative gamma environment, then we would be expecting more drama, more extremes. But we're above the 10, we're doing fine. There's absolutely nothing signaling that we're overbought, overextended, or that it owes us any sort of mean reversion, because it doesn't at this point. Not seeing much on a capital rotation basis that stands out other than tech being flat over a 5-day period. But, tech generic, it's just so vague that it doesn't really line us out. Cloud computing, chips, telehealth, something, right? Some way to get nuanced when we talk about tech would give us some more insight on this. But generically speaking, tech being down negative over a 5-day period, while consumer discretionary is 2% and finance at not even 1%. It does imply that tech has room to play catch up. So we're getting this move in chips this morning. Let's see if it broadens out into some of the older, more legacy tech. Just off the top of my head, think of, like Dell or HP or, some of that old tech. See if we get any kind of run in that space. Just a rising tide lifts all boats scenario, right? I don't know if we're going to get anything out of it, but wouldn't hurt to take a look. Looking at things that are down this morning, Bitcoin was up more than 12% in a 5-day period. So a little bit of a pullback after that makes sense. Down 2%, which still leaves it up 10 over a 5-day period. That explains why we have a bit of a pullback, right? I don't see that as bearish at all. It needs to pause, get a little digestion, get a little correction so that it doesn't get just completely unstable. So Bitcoin Mag 7 down, volume is down. So at least it's a double negative this time, maybe a little less confusing. That's positive for the Mag 7 group. And other than that, they're the only things that are down worth note other than the VIX. The VIX is down 1 3/4, but it's still up 6% over a 5-day period. So it's still elevated. Looking at what's up this morning, China and then more China chips. Mag 7 up, volume is up. So at least it's a double positive. China again, tech, China, Mag 7. Hey, getting some quantum this morning. Uranium, robots, metals and mining. And then we kind of run out from there. The S&P growth ETF is up this morning. Nice. Doesn't normally get a lot of volume in the pre-market. I don't know if you guys know JC Perez from All-Star Charts. Someone just sent me this. I believe he made his own index. You know how we take all the Mag 7 names and we put them together and we made our own index out of it? We just used the plus sign on Thinkorswim and or TradingView, you know, and you can just make your own index. Well, JC Perez has a list in it. It looks like he's putting together something on the drones. It's an interesting idea. I'll have to flesh it out. The thing about the drones, you really got to be careful about, you know, that there's so many different groups. You've got your vertical takeoff and landing taxi type drones. You've got your military drones, then the shipping drones, then the anti-drone companies, which is really kind of cool. Then LiDAR companies, satellite data, software. You just start to fall down the rabbit hole. But yeah, we'll dig into it, see what would come out of it. All right, so China or KWeb has been in this zone here. We're getting the higher lows on the bottom, but really capped off since the June 11 top here. And if we zoom out, it's a part of this angled trend line. We're testing a breakover. So get through the angled trend line, test that 35.5 top. Break out of that, we can take a run towards 38. The lower edge of this is the anchored VWAP, right? We come back here, it's the year-to-date anchored VWAP. So bullish above the anchored VWAP, bearish below. So far, so good. But it's a heck of a gap up this morning. And, you know, these really big gaps up, a lot of times they just don't stick, right? We fade back down. The thing is, it's all the way up here, right? It's hard to see that on the video, but that's where we're at this morning. That's this. So we're at that angled resistance. Got to get through that. Then 38's on the table. It's like a $2.50 move. Could put in, the cheapest way to play that would be to just like get a butterfly around 38. Or if it only has, if you can get 50-cent options, then you could do something like a butterfly at 37.5. Chips are up 2% this morning. Really messy. Above the anchored VWAP, past that breakout point, 270. Past this double top from 2024. Now, this may end up being that classic example of the gap up and then the fake break. I don't know if it's going to be, but this is the good start of it, right? These aren't trend candles, the ones that turn hollow to work with the trend, but here's one of those gap up examples where it just dumped back down again, but only in the short term, right? Even on the dump back down, it caught at 50% of the big breakout bar. that held a support, and then we continued on. So for a short-term trade, if you had, I don't know, got some calls or something, as long as you didn't take too much of a volatility crush, the calls might have made a little bit. At this point, 290 or the Globex low would be the level that I would stay focused on. Breaking that implies that we can get this gap closed. So an intraday short back to like 285. It's a $5 move from 290 to 285. The thing is, I don't like shorting from the hole, right? And I don't like to buy puts after we've already begun a fall. I'd rather buy the puts while we're still moving to the upside. And so far this morning, this is giving us no reason to believe that it's going to flip. So looking at the things that are up this morning, it's really concentrated in the Mag 7. And sure, I mean, we got chips up, right? But chips are in the Mag 7. So that doesn't really say much. And tech, generically speaking. So when we put tech into the mags and chips into the mags, what we really have up this morning is the Mag 7, pot stocks, and China. That's a really concentrated rally day, and it wouldn't take much to see it begin to unravel, say like NVIDIA taking a nap. With the banks kicking off earnings, I'd really like to see banks in this up more. And the fact that they're not says, we need them. So if we do get through 8:30 without crashing and burning, get into the open, we want to see finance. I got KRE, but you can use whatever. We want to see finance kind of hold the line, maybe even keep up. And we don't want to see the Mag 7 or the NY Fang is what I've got here. We don't want to see that start to give it up. Mags works in the pre-market, so NY Fang only works from 9:30 to 4. If you want some pre-market stuff, MAGS does a good job. From a rising tide scenario, we'd want to see a broad market participation, right? That would be the plan. Otherwise, this is a liquidity gap all on its own. Kind of implies, that at some point it owes us that 6,300. And right now we're just dancing around VWAP. So if we wasn't 7 minutes away from the data print, I would be saying we could get reciprocation. Whatever we had on the top, we would get on the bottom. But instead, let's get through CPI, see what that big candle is, and then plot it and measure it. If this is what our CPI looks like, I mentioned it at the beginning, how you can measure the entire move, plot the 50%, and then you can plot to the upside something like 50% to the upside and 200% to the upside. If you think it's going to go down, do the same thing to the downside. And you can always do that, right? So that's the one from last night, just to use it for an example. We're going to get one at 8:30. That's the one that you're going to want to use because it'll be the most current. There's the 111 rejection that I use most of the time, right? most of the posts. So that's what I got, guys. We got to get through CPI. Use it. Use that big bar. Push it in both directions. Lay out your levels. Trade what we get. Watch the headlines. Be careful. Be safe. I'll see y'all tomorrow.